Good afternoon, ladies and gentlemen. It's 12 noon Eastern time here, so I'll say good afternoon to those of you joining me here on the East Coast. Of course, good morning to those of you who are joining us in the Central time zones, the Mountain time zones, and the Pacific time zones. Of course, I want to say good evening to any of you who may be joining us from across the pond in parts of UK or parts of Europe, and good early morning for those of you who might be joining us from parts of Australia or Asia. Well, welcome to today's presentation for RadioActive Trading. We're going to do something a little bit different here today. Today we're going to talk very quickly about the initial radioactive setup. Why do we enter these positions the way that we do when we first open a new radioactive trade? Focusing on the three core principles of radioactive trading, which actually apply to any trade, any option strategy that you might be using in your portfolio. And then today, the main focus is going to be discussing the comparisons of trade entry. Once we introduce, of course, the married put setup we use for radioactive trading, common questions that always come out, well, isn't there a better way to enter this position? Do I have to buy the stock? Can't I do a synthetic rather than doing the married put? Well, we're going to look at the comparisons of why we don't do that, and we're going to show you some real-world where are we now examples from the position that we might have entered from Tuesday's presentation on Foot Locker, and then, of course, we'll handle a few roundup questions. Now, for those of you that are brand new, the radioactive trading techniques, of course, is a unique trading methodology developed by Kurt Frankenberg about 12 years ago after he spent a few $1,000s to take a weekend course to learn how to trade covered calls and spread positions. He went out on his own, and in a short time period, he ended up losing most of the money that he had set aside, simply following his guru's advice. Well, he didn't give up after he lost all the money on covered calls and spread trades, and what he decided to do was sort of flip the risk-reward profile in his favor and to skew the market odds in his favor and focus on limiting risk first rather than looking for a higher return. Over time, the technique is developed into 12 different adjustments we make off the initial setup to reduce the initial at risk, potentially bulletproof the position, which some of you might have seen in the Foot Locker example from Tuesday, and of course still be able to earn extra income that we could do with other strategies. Of course, the main focus of an initial radioactive trading setup is to cut the losers short and let our winners run. Now, for those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've been trading radioactively for about the past 8 years. I'm sorry, this is an older slide. I've been with Power Options for about 14 years now, and I've been trading radioactively since about the end of 2007, beginning of 2008. I started out the same as most of you, got introduced to options, did some covered calls, long call positions, traded naked puts, calendar spreads, credit spreads, straddles and strangles, and more. And over the past 8 years or so, more than 50 to 60% of my allocated trading capital has been devoted to radioactive trading. And it's because I've had more success long-term with the radioactive trading techniques than I have with those other strategies. Now, that's just a little bit about me. I want to get a few insights here into a little bit about you. The first thing I'd like to know is what kind of options strategies are you mainly trading in your portfolio right now? Are you mainly trading covered calls and naked puts? Are you looking at spread trades, vertical spreads, debit spreads, and so forth, iron condors even? Are you buying options, buying calls, buying puts, speculating on the market movement? Or maybe you're doing straddles and strangles right now with earnings season. I got a story for you guys on that very quickly. I did enter a straddle or strangle a few days ago, actually about a week ago, for FOSL, fossils, way depressed, down at $30 per share. And I think I bought a December 29 call and a December 32 put, if I'm not mistaken. Earnings came out at close of business yesterday, and I was excited when I saw in the after hours the stock had moved up about 9%. But of course, when the market opened, it had already reset and was only up about 1%. So the strangle was a loss at the time. And then I waited for it. It came back up a little bit. It moved back up today, but it's still a loser there. It's still losing money. So now I have to go through and play with the position a little bit. And why did I choose December options? Well, we'll talk about that in a little bit too when we get into the three core principles. But in addition to that, any other straddle I would have entered would have had a larger loss even using the weekly options on fossil for yesterday's earnings. All right, well, I've had the poll open for a little bit more than a minute. Let me go ahead and close the poll, folks, and I'll share the results with everyone. Looks like the majority of us are doing 29% covered calls and naked puts, and also 29% are doing other. If you want to, you can go ahead and use the question pod and let me know what kind of other strategies you're trading. We have an even split with 14% doing the vertical spreads, 14% doing option buying, and 14% doing calendar spreads. Now, the reason I wanted to know this is when we go into the trade comparisons, the discussion of what are some of the synthetics that investors ask about in relation to radioactive trading really apply to all of the answers here. So I think you'll find that pretty interesting as to why we might not be using naked puts to open a radioactive trade, why we're not using a straddle and strangle, or why we're not using a calendar spread. All right, so just as a curiosity, let's see here. We'll save that. Let's get back to the main presentation here. We'll save some of those other polls maybe for later on. All right, but let's move on. Talking about the radioactive trade, the initial setup of a radioactive position. What we're going to look to do is an initial trade is always opened with a unique form of a married put. So instead of buying stock, so I might buy a stock at, let's say, $60 per share, and then today, and then buying in August or maybe a September, 55 or 52 or 50 put for a cheap price of 60 cents or 80 cents, which you might have seen of information on protective puts or married puts on your broker. What we're going to do is buy stock and buy an in-the-money put that is at least 5 months out in time or more. This setup, although it seems a little bit different, it allows us to take advantage of the 3 core principles of radioactive trading. Now, the initial setup is a bullish setup. I'm looking for stocks that I feel have the potential to move up 5 or let's say 4 to 8% or so within the next 30 to 45 days. Not always right, which is why I have that put in place to begin with. But it is a bullish play, but we also do discuss in the blueprint ways to approach this in a bearish market. Now on Tuesday, we showed our current position on Foot Locker, which is bulletproof. It cannot lose any money, and we still have infinite upside, and we're going into earnings next week, August 19th, in a trade that's guaranteed to make us at least 1.8%. We could probably close it right now for a 6% gain, but we still have further upside as we head into earnings. But on Tuesday, if I was opening a trade new, I would have bought shares of Foot Locker at the price of $58.32. At that time, our January 2017 60 strike put, so we're about $2.68 in the money, was priced at $5.30. So if I entered a radioactive trade, I would have invested for 100 shares $6,362 into a Foot Locker RPM. Purchasing the put gives me the right to sell to close Foot Locker at any time between now and January expiration for $60 per share. The stock could fall to $30 per share at earnings, but the most I could lose is $3.62, or 5.7% of what I invested in the trade. This is far superior to a stop order, which is assumed insurance. I'm not expecting Foot Locker to lose 50% of its value when we head into earnings next week. However, if it did happen, and I had a stop order set at 7%, if Foot Locker dropped down to $50 per share, or if it dropped down to $45 per share, that stop order is simply a market order, telling my broker that if the stock's anywhere below this 7% from where I entered the position, maybe about $4.20 or so, to go ahead and close it. But they can only give me back what the market's offering. So if the stock fell to 45, my alert's triggered at the open, they sell my shares of stock at $45, and I'm looking at a loss of $13.32 on the position. All right, so here's our profit and loss chart for what would have been a Foot Locker position on Tuesday. We do have the infinite upside. We have the guaranteed loss. But notice, I'm sorry, guaranteed limited loss of only 5.7%. But notice this curved red line here, the curved red line at the halfway point. Even though my static break-even is 63.62, which only occurs really at expiration, meaning if I held this position all the way to January expiration, made no adjustments, accepted no dividends, and the stock was trading below $60 per share, that's when I'd realize the maximum loss. Because we bought the put several months out in time, the put doesn't decay one-to-one with the stock. I'm not 5.7% behind the 8 ball when I first opened this position. If I did open this position Tuesday, we could have turned around, sold the stock for 58.30 or maybe 58.35, and sold the put for maybe 5.20 or 5.25. So all we're really risking is the bid-ask spread when we first open the position. And as the stock moves up, the put doesn't decay one-to-one. So at the halfway point on November 1st, I might only need the stock to be trading at $60 or $61 or so to be at break even. The static break even only occurs at January expiration, which is more than 5 months away. So we're in a position now where we have a guaranteed limited risk position, much better than a stop order, and infinite upside. That initial setup follows the 3 core principles of radioactive trading, which are really the 3 core principles any investment that you do with options or in any strategy. Buying the stock and buying the put forces us into an ideal size trade. Because I'm buying stock, I can't overinvest. I'm not using leverage in this scenario where I might be looking at positions to take on a 33 or a 40 or even a 50% loss or potential 100% loss of what I invested. It saves us from overtrading, and we're forced into a proper position size. All of you are familiar with this. Those of you that are buying calls, you might have $10,000 of free capital in your account. You see a position that you're really positive on, that you're really bullish on, and has positive news, and maybe an at-the-money or out-of-the-money call or even an in-the-money call is only priced around $4. Well, you're not going to invest $10,000 into that one position, but you might do 10 contracts or you might do 20 contracts, but you have the chance to use leverage and get yourself into trouble. The second principle is the at-the-money bell curve. What the at-the-money bell curve shows us is you look at any option chain for any expiration, and you'll see that the options that are right at the current stock price have the highest time premium. Not the highest total premium, of course, but the highest time value. And as options investors, that is our real profit, is the time value that we manipulate, collect in premium, or are able to swap, which is some of the things we do with the income methods at RadioActive Trading. When we're selling, we want to kind of sell at the money to maximize the time premium in our favor. And when we're buying options, those of you doing the straddles and the strangles, or just buying options as well, know that we want to buy in or out of the money to lower the time value so we don't get hit with a rapid time value decay. And speaking of time decay, the third core principle is the red line, the radioactive decay line, or simply the time decay line. What this shows us, of course, that are options that are closer in time. 7 days, hence the popularity of the weekly options that are now available on about 1/10 or so of all optionable securities. 14 days are going to have rapid time decay, so as an option seller, that might work in your favor. But when you're buying options, you don't necessarily want to buy closer in time because you give yourself less time for the stock to move in your desired direction, and whatever time decay you pay for, it works rapidly against you. So here's just an image of the at-the-money bell curve. Spell check didn't work for me on this slide, ladies and gentlemen. I do apologize. So there's our at-the-money bell curve. And the at-the-money options here we see will always have the highest time value. If I go further away to out-of-the-money calls, we'll have a lower premium naturally. So if our stock's trading at 60, the 60 strike call would have the highest time premium, as would the 60 strike put. But as we go, let's say, to the 70 strike, the 70 strike call might only be worth 40 cents. So time value is much lower. And the 70 strike put might be priced at $10.40. So there's $10 of intrinsic value, but only 40 cents of time premium. Same on the other side. The in-the-money call, let's say we look at the 50 call, well, that might have a value of $10.50, but only 50 cents of that is time premium. And then the out-of-the-money 50 strike put would only be worth 50 cents. One would be buying in the lower time value ranges and would be selling at the money to maximize the time value in our favor. And then the radioactive decay line. assuming, which we know is never true, but assuming that volatility, the stock price, and other factors remain the same, when we look at near-term options, we have a rapid time decay in the last 30 days. So we go further out to 60 days, we're going to see a lower time value decay in the first 30 days and then the fall off. If we go to 90 days, slower time decay against us and then the rapid in the last 30 days. And if we go at 120 or 150 days, we'll see a slower time value decay until we start getting into that 60 days to expiration or 45 days to expiration as well. So when I'm selling, we want to be here. We want to be in the shorter time frame, have the time decay work in our favor, and also at the money to maximize the time premium. But when we're buying, we want to be buying further out so the time decay is less, and naturally we give ourselves more time for the stock to move in our desired direction. Now, I didn't talk about position sizing. That's going to be apparent when we talk about the trade comparisons. So looking back at that initial setup of a radioactive trade, we have two basic components when we first open a trade. We are buying shares of stock, which is capital intensive. And we're also going to buy an in-the-money, no more than 20% or so, because we don't want to cancel or have a zero expectancy of potential profit. But we're going to buy an in-the-money, 1 or 2 strikes, far out in time put. Okay? And one of the things that we always see, one of the questions I do always get, is why am I adding a bearish instrument? Why am I adding a put at all to a bullish trade? Well, think about it this, those 24 or 29% of you that are doing covered calls, aren't you doing the same thing? You're buying stock that you're relatively bullish on, and you're adding a bearish instrument. Selling a call by itself, a naked call, is the most bearish option strategy that you can essentially do. It has infinite risk to the upside and a small premium to the downside. Okay? So that's the same thing. A covered call is taking a stock you're kind of bullish on. You're generating premium, of course, but you are adding a bearish instrument. The put does two things for us. Number one, obviously it insures the stock. But it's not just insurance. The put is a second asset that we're going to manipulate. As the stock moves up and down, we're going to have an increase in intrinsic value or an increase in time value as the stock moves up, which we can manipulate in our favor to lower the risk or lower the cost basis of the entire protected position or both. Now, we're not going to look at the trade simulator right now, but let's talk about that initial setup. Aren't there cheaper ways to own a stock or to mimic stock ownership? Of course there are. That is the whole appeal of spread trades. Buying options, so I don't have to pay the money to buy a stock, buying a call or buying a put, speculating on the market movement, or taking advantage of a straddle or strangle to try to take advantage of an earnings or certain announcements that's coming up as well. Well, the first comparison we're going to look at today against the radioactive setup is a naked put, cash secured naked put, or selling a put option. Many investors will try to enter in a stock at a discount by using the naked put strategy. Essentially, what we're going to do is sell a put option. That's going to generate premium against us. The obligation of the put, of course, is we may be forced to buy shares of stock at the strike price. The stock falls below it. By itself, it is a parity trade to a covered call. A cash-secured naked put, of course, is a parity trade to a covered call. When we were looking at Locker on Tuesday, we were talking about the stock trading at 58.32. Well, I may sell a 57.5 put for about $1. The stock stays above 57.5. Put expires worthless. We keep the premium. If I did a covered call and I bought the stock at 58.32 and I sold the 57.5 strike slightly in the money, we might have generated about $1.80 or so, or $1.85. So if the stock stayed above 57.5, we'd get assigned and make about $1.05 premium. And if the stock falls, that's where we have the dark side, where we can take a significant loss if there's a large gap down in price. On August 9th, on Tuesday, when we were looking at Locker, I could have opened a cash-secured naked put and sold to open the August, only about 11 days, 12 days to expiration, 57.5 strike put for $1.05. So the maximum profit on the position would have been $1.05 or $105 per one contract. Stock stays above 57.5, put expires worthless, I keep the premium, and I have a 1.8% yield. Okay, the yield is based on my monetary requirement to enter the position. If I did a cash secured put, my broker would require me to have $5,750 on hold in my account for one contract. So in case the stock fell and I was put the stock at $57.50, broker wants to make sure that I'd have the capital on hold to fulfill the obligation. Now we do keep the 105, but the maximum risk is $5,645. The strike price where I may be forced to buy shares minus the premium that I collect. This is an opposite view of what we use at RadioActive Trading. This position allows us to cut winners short, but allow the losers to run. Here's our profit and loss chart, that 57.5 strike. So the monetary requirement would be $57.50. We took in 105. We have a return of about 1.8, 1.9%. As long as Foot Locker, which it is today, it's at 59.10 earlier this morning, so as long as it stays above 57.50, our put expires and we keep the premium. What are we missing? Well, with a cash secured naked put, if Foot Locker goes to 60, 62, $63 per share, we're not getting any more positive delta. We can only make the 105. Now, that's a good return for an 11-day trade, don't get me wrong. But if our object, when we research and analyze the stock, was we felt it might move up 4 to 8%, we're cutting ourselves short. And if the reverse happens, if the stock falls, let's say 5 or 10% from when we looked at the position, we have a chance for significant losses to the downside. Okay, this is sort of the dark side of covered calls and naked puts. As the stock falls, if there's a sudden gap, the stock falls 20%, well, we'll keep the 105, but we'll get put the stock, and we're essentially looking at an unrealized loss, probably 18, 19% or so. That's going to take a long time to get back to break even, just selling calls against it now that we've been put the stock. All right, so let's take this into another perspective. This allows us to get into stock at a discount. If the stock was trading right around $57, next Friday's expiration, August 19th expiration, we'd be forced to buy shares of stock at $57.50, but we keep the 105. So I'd get into the stock at a price of $56.45. So now that that's a potential, why don't I create a calendar spread by generating premium right now, selling this put, and buying the same put I would have used for RadioActive Trade, the January 60 put at 5.30. So now we'll take in a premium of 105. We'll pay 5.30. Oh, sorry folks, didn't edit this. This would be the 2017 January 60 put. I promise I edited the other slides. This one just got away from me. Okay, so we bought the 60 put, same as we would have with RadioActive Trade, at 5.30. Now my total debit is 425. I don't have to put up the margin at 57.50 now to cover this transaction because the broker sees that I'm guaranteed to get $60 back. It's a debit spread, so I don't have to cover the extra $250 here or the $57.50 I would have with just a cash secured naked put. This allows me now to potentially get into stock at $56.45, the $57.50 minus the 105, and I've already got the put in place that I would have used for the RadioActive trade. Is this a better transaction? Well, now it's a bit tricky. In this situation, we do have two ways to lose. If the stock moves up in price, we don't have a positive delta as we would with the RadioActive trade setup. When I enter the married put, the stock essentially has a delta of 1. My put maybe has a delta of 0.6 or so. So as the stock continues to move up, we have that profit and loss chart with a limited risk and then infinite upside profit potential. But here, our max risk is still $4.25. Okay, it's more than the $3.62 we would have had with the married put setup, and that max risk is to the upside in the direction we thought the stock was going to move. Also, this puts us into two different ways to lose. If the stock does gap down, I can lose on the cash secured, or the calendar put spread, excuse me. I'd also lose on the married put, don't get me wrong. But in this case, what are we looking at? We're looking at a position where I need it to stay in a tight range, maybe only 1.5% up or 1.5% down from my short put strike price at the 57.5 value. So this kind of goes against what I wanted to accomplish. Is there a potential for a high return on this trade? Well, sure. It's a leveraged spread trade, but you're risking 100% of what you invested into the position, and it's a higher monetary risk than we would have with the married put trade. Okay? Can you be successful trading this way in lieu of doing a radioactive trade? Well, I'll say yes, if and only if you can consistently pick stocks that in the first 30 to 60 days, or maybe 15 to 30 days, trade within a 1 to 1.5% range up or down, and then in the following 2 or 3 months after that, move up 5 to 6%. If you can pick that on a consistent basis, meaning more than 70, 75% of the time, you could be successful using this leverage trade. But if you can consistently pick stocks that in the first 15 to 30 days only move about 1% up or down, and then the following 3 months after that move 5 or 6% up in price, you probably don't need to be in this webinar, and you probably don't need my help investing. All right, now let's take a look at the straight comparison between the two. The difficulties with the calendar put is you're trying to time your trade. Okay? You found a position that you're bullish on, but rather than putting yourself in a position with a positive delta to the upside in the direction you thought you go, that you thought the stock was going to go, you're capping your gains, and you're trying to find a position that is going to stay in a tight range over a short period of time and then will go up afterwards. You need the stock to be trading right at or just below the put strike price at your expiration. If the stock goes up as we expect, we can suffer large losses, especially if there's a gap up because of earnings, where Foot Locker is going to have in the next Friday morning at the open. This naturally wouldn't be a position we'd want to enter. And if the stock moves up as we saw Foot Locker has done today, we're almost at a loss on the calendar put spread we could have entered Tuesday. You're going to have to scramble to buy the stock so that you have the positive delta still working at your favor. The straight side-by-side comparison. The radioactive trade, the max risk would only be 362 or 5.7% of what we invested in the position. The calendar put we saw would have a risk of 425 or 100% of what we have invested in the position. Because I'm buying the stock and I'm using a large amount of capital for the radioactive trade, I'm forced into an ideal size trade where I'm only risking 5.7% of what I have invested, and I can set that up to be less than 1.5 or 1% of my total portfolio value. The calendar put only costs us $425 to get into. So if you had $5,000 on hold in your account, you may do 10 contracts. You suffer the risk of overtrading. Now you'd have $4,250 invested in the trade, and you could lose all of that. Okay, so you have the risk of overtrading. The RPM has the unlimited upside, and as we saw the calendar put, we have that capped upside. In fact, the maximum profit is only seen if the stock's trading right at that specific strike price at expiration, and you have the potential to lose two ways, if the stock moves up or if the stock moves down. So although selling the put or trying to simulate the married put by entering the calendar put spread would cost less money to get into, and you may be able to get into the position at a lower price, get into the stock at a discount, you run the risk of overtrading. You're kind of trading against yourself because now you have that small capped gain, and if the stock moves up, you can lose, and if the stock moves down, you could lose as well. Now, I want to encourage anyone, if you have any questions just about the calendar put or using the naked put to get into a radioactive trade to begin with for the lower cost, go ahead and use the question pod and send those in. We'll see if any questions come in just before we move into the in-the-money long strangle comparison. All right, so let's just, I don't see any questions coming in, but I can always go back as well. Again, here's that setup that we would use if we'd opened a radioactive trade on Foot Locker on August 9th. We would have bought shares at 58.32. bought the January 60 put for 530. Again, our total investment would have been 63.62, so our max risk would have only been $3.62, or 5.7% of what I invested into the position. Many investors who see the RadioActive setup will say, well, why use the stock at all? Why not use a long call to simulate stock ownership? Okay, many of you are doing that. About 14% of you are buying calls and, of course, using straddles and strangles. We often love to use leverage to mimic stock ownership. I'll be honest with you, I never want to buy price line to enter a married put or even a covered call because the thing's at $1,600 per share, right? That's not viable for my account size. I may buy calls or do calendar spreads if I'm looking to trade price line or even something in the $500 range, okay? And to mimic stock ownership, we'd buy an in-the-money long call with a relatively high delta. You know, with Foot Locker trading at 58.32, I may look to buy a 50 call, a 50 strike call. It's going to be about $9 or $10, so I'm going to have $8 of intrinsic value, and then you're always going to have some time value, even if you go towards a delta of 0.9 or 0.8. Okay, this is going to give us a leveraged cost, a very low cost, and the call is going to gain in price as the stock moves up. So another question that always comes in is, can I substitute the long call for stock and do better than the RPM? Okay. Oh, okay. First off, a question came in from Paul. Paul said, you said there was a way to reduce the 5.7% max loss to 1 to 1.5% of Foot Locker. How? I'll get to that towards the end of the presentation. I'll show you where the Foot Locker position is now after about 2.5 months, 3 months in the trade, Paul. But what I was referring to, and we'll show this a little bit later on too, when we talked about the RPM risk, that investment, let me go to the other slide. I apologize, Paul. Let me transfer over to the other slide here. Here we go. This would be the setup. Okay? Now, I have a risk of 362 or 5.7%. As the stock moves up and down, we're going to use income methods that are discussed in the blueprint to generate income, lower this risk, and leave our upside open. I'll show you where the Foot Locker is positioned at the end of the webinar. My actual one, not the one we opened on Tuesday, although we can look at that too. All right. What I was referring to is that this is my total monetary at risk. If I had a total portfolio size, Paul, of $40,000, okay, now, and let's say I had $10,000 of free capital, 25% of it. Well, forcing myself into an ideal size trade means I can only buy 100 shares in one put. I'm still risking 5.7% of what I invested into the position, but the risk of $362 is less than 1% of my total portfolio value. So even if this stock crashed tomorrow or earnings next week and dropped to $30 per share, the most I could lose is $362 on this position, which is less than 1% of my total portfolio value. So I can stomach that loss and be perfectly fine. Okay, that's proper position sizing. It's twofold. I don't want to take more than usually 8 or 8.5% at risk on any radioactive trade I open, and I want that monetary at risk, even if I did 200 shares or 300 shares, I want that to be less than 1.5 or 1% of my total portfolio value. But the position I'm in on Foot Locker right now has a negative 1.8% at risk, meaning I have a guaranteed profit no matter what Foot Locker does. Right now I could close it for about a 6% gain, but I still have unlimited upside headed towards earnings next Friday. Okay, that's what the income methods do. All right, but that 1 and 1.5%, what I was referring to, is proper position sizing in your portfolio, a second layer of protection that we use at RadioActive Trading. All right, so now a strangle is a combination of buying a call and buying a put. Many of us, and what I did with that fossil trade that didn't work out for me in earnings the other day, typically a long strangle is entered by buying an out-of-the-money call and buying an out-of-the-money put. So if I wanted to trade Foot Locker that was trading at 58.32, I may have opened the position by buying, let's say, a 62.5 call a couple weeks out or a month out for maybe only $1, maybe $1.50, and I would have bought a lower strike, maybe 55 put, for maybe $1.20 or something along those lines. So it gives us kind of a U profit and loss chart. When we look at a RadioActive Trade, we're buying an in-the-money put to maximize our protection, to maximize our insurance. You get what you pay for. I could buy an out-of-the-money put for January, but my total risk would be in the 9%, 10%, or 12% range. Instead of buying the 60 put that we showed with the 5-line setup, if I had bought a 55 strike put, Foot Locker would have to drop to 55 before that insurance kicked in. So I'd probably be at a 12 or 13% maximum loss instead of a 5.7%. I'm trying to stack the market odds in my favor and keep my risk to single digits. But we're looking at the position. We already bought the stock in the money put. So the idea is, instead of buying the in-the-money put option, why don't I buy an in-the-money call and pay 1/10 or less of what I'd pay to get into the stock position? So that would be an in-the-money long strangle. I'm buying an in-the-money call and an in-the-money put. This position would give us infinite profit to the upside and to the downside. And the true risk on the position is the time value that you have to pay for both options. On Tuesday, we would have entered the January 60 put for the RadioActive Trade. So let's stay with that one. We could have bought the 2017 January 60 put for $530, as we saw. It's 2.8% in the money, not that deep, 5.7% time premium. That's the risk I had on the RadioActive Trade, and it has a delta of about 0.55. Now I'm going to go deeper in the money with the call, because this argument that comes up is, well, you need a deeper in-the-money call to have a better delta so it moves one-to-one with the stock. The one thing I want to mention to you all is that, okay, well, let's look at this. We would have bought on Tuesday the January 50 call for Foot Locker was trading at 970. It's about 14% in the money. It's only a 1.9% time premium for that option, and it has a delta of 0.78. You might say, well, Mike, why aren't you using a comparison of something that has a higher delta on Foot Locker, let's say the 45 call, or maybe even the 40? Because logistically, it's not realistic, okay? The 40 call for Foot Locker, the January 40 call for Foot Locker, when it was at 58.32, had a smaller time premium of only about 0.8%, okay? It was about $18.58 or something along those lines. Would have been midpoint on Tuesday with the stock at 58.32. The delta would have been close to about 0.95. There is no open interest and no volume. That tells me that the option has either never traded or I'm fighting against the market maker the entire time to get any liquidity. So going with an option with a delta of 1 in a lot of scenarios is not realistic. Maybe I could have gone to the 45 for this example at around 0.88 delta at the time. It had 2 open interest and no volume in the last 20 days or 15 days or so. So again, I'm fighting it. So I stuck with the 50, and we'll just use it as an example. So where are we at now? I got to pay $970 per contract for our in-the-money 50 strike call, $530 for the January 60 put that we would have paid in the married put. I now have a total investment of $15. Now, in a normal out-of-the-money strangle, that would have been my risk if I paid $15. But with an in-the-money strangle, we've got this $10 strike difference, okay? And so they're both in the money at the time I open the trade slightly. Our risk is only 5 points, even though we put in 15 in the strangle. Why? Well, let's think about if Foot Locker is trading at $55 per share. Let's just move to the next slide. Here's our profit and loss chart for the position. If Foot Locker is trading right at $55 at expiration, we hold it all the way to expiration and do nothing. Well, our 50 strike call would be 5 points in the money. Our 60 strike put would be 5 points in the money. So we'd be guaranteed to get 10 points back, so we'd only lose 500. That's the difference with the in-the-money strangle. But the risk is still $500. In this range, it's a wide range. Of course, this is at expiration again. We see the curved red line here at the halfway point. It's a little bit shallower. We're almost at the break even there at the midpoint, not profit, but almost at that bank here. So we have a 20-point upper and lower break even, but that is at expiration. We're not going to focus on that because we bought the farther out options. The risk is leveraged, just as we saw before. We now are taking on a 33.3% risk on this strangle. And what does that mean? Well, many of you have been following Kurt's blog recently regarding the expectancy of profit, the lie of leverage, and more. And when we look at the gambler's ruin curve, you know that if you suffer a 33% loss on a position, if I did take the maximum loss on this strangle, a 33% loss requires a 50% gain on what I have remaining, which would be the $1,000. So I'd have need a 50% gain just to get back to break even on this position. And it gets slippery. If you took a 50% loss on a leveraged position, you need a 100% gain on what you have remaining to get back to break even. And that's one of the reasons why we trade radioactively, because on the Foot Locker married put, if I took a 5.7% loss on the position, that $362, I would only need roughly about a 5.9, 6.1% gain to get back to break even. That's stacking the market odds in your favor. So are we mimicking stock ownership by buying this call and still having the put in place? Absolutely. Do we leave our upside open? Yes, we do. Can we also profit on the downside if the stock falls against us? Yeah. It's one of the little benefits that this gives over the radioactive trade, I'll be honest with you. But there's a way also that we showed in Foot Locker on Tuesday, the archive webinar, where I can enter an RPM in this fashion and profit in both directions if the stock moves up and the stock moves down. That's income method number 12. We discussed that for the real Foot Locker trade that we're in when we opened it up in May on Tuesday's webinar, okay? Okay, so I had another question come in, William. I'm going to have to get to that at the end of the presentation because when I get to the Foot Locker position, all right? Okay, so let's move on now. Let's talk about this. What is the difficulties with that in the money long strangle? If I open the married put, I'd put in about $6,300, almost $6,400 into the position. If you open the in the money long strangle, you're only putting in $1,500. So let's be nice and say that that's about a third or so of what I'm investing in the position. But again, that puts you in the lie of leverage. You're going to have a higher monetary risk on the position. As we saw, it's going to increase because you're fighting two time values. Another problem that's hidden with the in the money long strangle is that you're not delta neutral, you're delta opposed. You need to see a much larger movement in the stock, one direction or the other, in order to realize a profit. Every example I've run for every customer, radioactive trading investor who's asked me to do the comparison of an in-the-money long strangle versus the married put sees a profit to the upside long before that in-the-money long strangle will. The lower capital is used, but that means you can run the risk of over trading as well. All right. So the side-by-side comparison, in-the-money long strangle, Foot Locker RPM is $3.62. The long strangle would have been $5 or 33.3% because of the lie of leverage. I'm forced into an ideal size trade with a married put. I risk over trading with the long strangle. When I open a radioactive trade, it's because I would have researched and analyzed a stock and selected a stock that I feel has the potential to move up 4 to 5 to 8% in the next 30 to 60 days. I start off with a positive delta position that matches my expectations. The in-the-money long strangle starts off with a delta opposed, not neutral. So sure, the stock might move up. You might not even see a profit on that in-the-money long strangle if the stock moves up 4 to 5% on the position. Okay, we're going to take a look at that as well. I had a couple questions come in. William, I'm going to have to get to yours. We got one more trade comparison to do. Then we're going to show you where all three of these positions stand had I opened them on Tuesday. Okay, and Mike says, Mike, will you post your slides with the recording? We typically don't do that. I typically don't have a means to deliver the slides on the archive webinars page or things along those lines. But Mike, I can send these to you. I may try to find a way to post them on the site in addition to that with Greg. But right now, since I don't have that, we don't have that programmed in and set up for delivery, may just send it to you manually. Okay, we'll take a look at that. But the archive will be posted this afternoon as well. Last but not least, and we're going to run through this quickly because we've got about 15 minutes left, but I do want to answer William's question that came in, and I also want to show where we stand right now. The big detraction, the obvious detraction for all of you who are savvy options investors and have been trading. You look at that radioactive trade setup and the profit and loss chart, and you say the setup is the same as buying a far out of the money long call, but the out of the money long call is better. Well, by definition, something can't be the same but better, okay? I'm not going to go to the RadioActive Trading blog right now. This was from an older presentation, but Kurt has several blog articles there where he has discussed why the long call is not a parity trade to the married put, but we're going to go into it right now. All right, so here's our initial 5-line setup for the Foot Locker position on Tuesday. We've got that ingrained in your head. The long call position on Tuesday, we could have opened. Instead of buying the stock and the January 60 put, the quote-unquote parity trade is I could have bought the January 60 call for $3.55 per contract when I was researching the married put at 58.32 and buying the January 60 put for 5.30. So we have an infinite upside profit potential, and my maximum risk is what I invested into the long call, which would have only been $3.55. Well, so that's fantastic. I lowered my risk by 7 cents. Instead of having a maximum risk of 362, I only had a maximum risk of 355. So this must be a superior trade. And I'll get to, let me go through this comparison, and then Michael, I'll get to your question right after that as well, okay? So I guess I'm wrong. The long call must be a superior trade. The risk is lower, 7 cents lower. Here's the profit and loss chart we saw of the, oops, sorry about that. It didn't update. It didn't save the last two, but here's the long call. Sorry, we know what the RPM looked like. The risk would have been 362, similar risk reward profile, but the risk was only 5.7% of that 63, 62 we invested. Here, we can almost say that you're investing almost less than just about 1/20th of what I'm investing in the married put. You're only investing 355. You are risking 100%, but I'm risking 362. You're only risking 355. So the long call keeps the infinite upside, and in this case, has a slightly lower risk. So this must be a superior trade, right? Well, not exactly. Let us talk about the nature of an investor. Okay, the long call and the married put have a similar risk reward profile. I am not arguing that with you. The picture tells 1,000 words. It's the exact same risk reward profile. That's not what we're commenting on. The problem comes with discipline. Buying a long call does not force you into an ideal size trade. It does not save you from trading against yourself and overtrading because of the lie of leverage. The long call risks 100% of the investment. And you're going to say, but the investment's only 355. It's less than what you're investing or risking in the married put. And you're right. But is that what you're going to do? Okay, let's take a look at two accounts. Let's say that you and I both have an account size of $100,000, and right now we're sitting on $15,000 of free capital. On the left, if I open the married put position, it would cost me $6,362 to buy 100 shares in one put. Guaranteed to get 60 back, so my risk is 362, or again 5.7%. Now with $15,000 of free capital, I could buy 200 shares of stock and 2 puts. This would put me at an investment of $12,724 of my available $15,000. But the risk is still only $724, which is under 1% of my total portfolio value. So that's forcing an ideal size trade. On the right, you've got a similar account. You've got $100,000 total, let's say, portfolio value, $15,000 of free capital, and the call is only going to cost you $3.55, which is your risk. Now with $15,000 in free capital, you could afford to buy 42 contracts, which means you would invest $14,910 into the Foot Locker January 60 calls. Now your risk is $14,910. You could lose all of that, which is 15% of your total portfolio value. These are nowhere near parity trades of one another. This is forcing an ideal size trade on the left. This is running the risk of overtrading. I know, I'm a devil's advocate. I'm exaggerating. You would not buy 42 contracts and use all of your free capital into one long call position, no matter how bullish you were on the position. But let's be honest about the nature of an investor, and I am the same way. This doesn't mean to be an insult, but we have to be honest about the philosophy and the nature of what we're doing. If you are disciplined, you saw me enter that radioactive trade, and let's say, or you saw me post it on Tuesday, and you decided to follow me but use the long calls to try to do a parity. If you were disciplined to only buy 2 contracts and only have a cost of $710 into the position, less than 1% of your total portfolio value, what are you going to do with the rest of that remaining capital? Are you going to put it on hold in your account? Or are you going to take that remaining sort of $14,300 and buy 5 calls on stock XYZ, 10 calls on stock ABC, 6 calls on stock 1, 2, 3, maybe do a bear call spread here or a bull put credit spread here? Okay, that's what you're going to do. The true parity trade to the radioactive profit machine, to the married put setup, where I'd buy 200 shares and 2 puts of Foot Locker, have $12,724 into the position, only risking $724, 5.7%, which is less than 1% of my total portfolio. The true parity trade with the long call would be to buy 2 January 60 calls. Again, cost is $710. You're still risking 100% of it. But if you leave the remaining $14,300 on hold in your account and don't trade anything else, now you can tell me that we're at parity, because you're not investing this $14,300 into any other positions. It's on hold and safe. You're risking $710 on the 2 calls that you bought, which is less than 1% of your portfolio. The minute you start taking more of this free capital to enter other long calls, other trades, other spread positions, we are no longer at parity. You can't tell me you're at parity because you have so much more exposure in the market than the radioactive setup. That is why the long call is not a parity trade to the radioactive setup, because it doesn't follow the 3 core principles. If I bought the January 60 call, am I taking advantage of the radioactive decay line? Absolutely. Am I taking advantage of the at-the-money bell curve? Yeah, I bought an out-of-the-money call instead of an at-the-money call. Still kind of at the money, but you had a lower risk than I would have with the married put. But you're not forcing yourself into an ideal size trade. You're not practicing proper position sizing, and this is when we start to get hurt. Okay? All right. Now, the other promise I made. Where do we stand right now? And then I'll get to all the questions that came in, okay? Oh, thank you, James. James says if the price of Foot Locker goes up, the OTM call will have a higher percentage gain. Yeah, but what are we after? Are you after monetary gain or are you after percentage? And are you careful enough to protect against the lie of leverage? Because if the stock moves down, you're going to have a lot higher percentage loss on the long call than on the married put. Lie of leverage works both ways. And here's where we are right now. I'm going to go ahead and let me do this real quick. Sorry, folks. Come on. Sorry, ladies and gentlemen. All right. Well, okay. Let me unpause the screen. Here's a portfolio, power options portfolio. Might be, I'm going to try to, I tried to increase the screen size. It didn't really work out for me. Let me try it one more time here. Hey, there we go. Okay. So hopefully you can see that a little bit bigger now. Wait for the screen to refresh for us here. The first line is showing us the long call position. On Tuesday, August 9th, I would have opened the position at 355. Foot Locker, by the way, remember, was at 58.32 on Tuesday. We're at 59.61 right now. Stock is up $1.17 today, but it's up $1.60, $1.29, I'm sorry, from when I would have entered the position. The midpoint price for our January 60 call, with an increase of over 129 on the stock price, is only at 370. that out-of-the-money call because it had a lower delta. It's not reacting 1-to-1. So I do have a 4.2% gain on the long call position right now, or $15. Okay? So, we've only been in the position for 2 days, but this is the real-world example. Had I opened this January long call in Foot Locker, the stock's up 117, the parity trade would have us at a gain of $15, or 4.2%. Okay? Now, let's scroll over here a little bit. And this is sort of the position analysis view on the portfolio of all of our positions. Liquidation value of the long call right now is 4.2%. In the married put, my stock's up $1.29. My put's valued at $4.45. I've lost 85 cents on the put, but for a position as a whole, I'm gaining $44. Now that's only 0.7% of what I invested in the position, and this goes exactly to what James said, and he's exactly right. But the $15 I've made on the long call is 4.2%, but I've made more monetarily on the radioactive trade. It's only 0.7% of what I invested. I understand that. My goal is not to make just 0.7% and liquidate the position right now. But I have a higher monetary gain on the married put than I do on the long call. Yes, the percentage gain is bigger. So what's most important? That comes down to you. Now keep in mind, if the stock had fallen $1.29, I'd probably be at a 0.5, 0.6% loss on the married put, and we'd probably be at about a 7 or 8% loss on the call itself. Lie of leverage works both ways. All right. Now, what about our other comparisons? Down here, I've got your calendar put spread, where I would have tried to get in the stock at a discount. And I know this might not be a fair comparison because the fair comparison would really occur on Friday next week when we hit expiration. Remember, we sold that naked put for 105. We still bought the same put to insure it that I would have in the married put. January 6th, you put at 530. Now, the stock has moved up, so we have a gain in the long call, in the short put in our favor. It's dropped down to 88 cents. So we have a gain of $18 on the put that we sold. But I've got a loss of $85, same I have in the married put, but because I own the stock and I have that positive delta setup, which I don't have in the calendar put to get in the stock at a discount, I am losing money on the calendar put spread where both the long call and the married put are showing profit. So this is actually a loss. Let's take a look here. Hurts, doesn't it? It's a loss of only $68 right now if I liquidated the calendar put. We wouldn't. We're going to hold it to Friday and see what happens unless it really gets away from us. What am I concerned with now that Foot Locker's at 59.61 and I sold a 57.5 put? Well, I'm losing that positive delta. I might have to consider buying shares of stock now at 59.61, hoping this put maybe still expires, right? And so I keep the 105. So my cost basis then would be $58.55. Look at what I already did better doing. Okay, the married put is performing better than the cash secure or the calendar put spread where we were hoping to get in the stock at a discount because the stock moved up. That is the risk. And I'm losing 15.9%. Remember the lie of leverage. If I liquidated the calendar put spread right now, in our scenario, we take about a 16% loss. If I take a 16% loss, I'm going to need about a 24, 25% gain just to get back to break even. Okay, so that's where it comes, the lie of leverage starts to come in. If Foot Locker continues to move up, I'm going to start losing on this position more, even at expiration when this time decay goes in my favor. Even when I lose this next 88 cents, I've already lost $85 on the long put, and if the stock continues to move up, that's going to increase. So the 105 is not likely going to cover it. Could it fall back? Of course. It could go back to 57.5 and the calendar put spread would look a little bit better. But the stock is up 2.2% from when I got into it. It's following my expectations, and the married put, we can argue it either way, but in my opinion right now the married put's doing better. Yes, I have a higher leveraged gain on the long call, but it's only profiting $15. These are real prices that I could have gotten filled on Tuesday for these different transactions. And how about our in-the-money long strangle? Well, the stock's up 2.2%. It's up $1.29 from when we opened the position. Look at this. The call moved up to 1055 from our price of 970, that 50 call with a delta of 0.78. Stock moved up $1.29. The delta gained 85. Seems about right. But the put also declined by 85. There is your delta opposed, where the married put is showing a profit right now. Small profit, I admit, of 0.7% because the stock moved up about 2.2%. The Strangle is showing no gain. You're at a complete wash on the position. And yes, this is using midpoint prices right now. If we sold to close the call at 1055 and sold to close the put at 445, these are all using midpoint prices, I'm at a wash on the in-the-money long strangle, which was a better trade because I used less money. Okay, that's kind of the problem there. That's the comparison that we want to see. And all the comparisons I run over the years for investors saying, won't you do better with that in-the-money long strangle or the long call, this is what you'd expect to see. And by the way, I'm not here to lecture anyone. I'm here to share with you my experience because I'm the same as you. When Kurt first introduced me to the radioactive trades after I've already been trading covered calls for 2 years and abandoned them, I trade cash secured naked puts for a while. I was doing calendar call and calendar put spreads. I was doing some straddles and strangles. I was doing credit spreads on the broad-based indexes and ETFs. So when Kurt first introduced these techniques to me, I had the same exact comments and I traded the same exact way that we're showing right now in my portfolio. I've been trading options for 6 years, 8 years since when I first met Kurt in 2008, and I figured, all right, well, I see what you're doing, but aren't I going to do better if I sell the put as I'm doing with my cash secured naked put and buy the put to get in position at a better price? Well, the 2 or 3 positions I did that way got me into trouble. 2 of them went up and I suffered a loss to the upside. 1 of them went down and I suffered a loss to the downside that would have been equal to the married put. I would have had a positive 2 months trading had I opened all 3 as married puts versus a loss. I tried the in-a-money long strangle concept, and too often than not, I got stuck in this void of limbo with the in-the-money long strangle where you're not delta neutral, you are delta opposed. You need a much larger swing. The comment that Jim mentioned about the long call does also apply to the in-the-money long strangle. If I was presenting this to you today and for some reason Foot Locker had gapped up 20%, the in-the-money long strangle and the in-the-money long strangle and the out-of-the-money long call will be showing a much higher gain percentage-wise, absolutely, and possibly even monetarily than the married put. How often do you pick stocks that move up 20% in a 2-day, 1 month, or even 2-month period? Okay, so James is absolutely right. The out-of-the-money long call, the in-the-money long strangle, if the stock swings wildly one direction or goes up, both will show a better percentage return. If the stock moves down, I'm going to lose 80, 90% on my long call position. The in-the-money long strangle will show a profit, but we won't be able to, we'll have a small loss on the married put position, and we'd have a small loss on the calendar put spread as well. All right, so let's go through some of the questions now that we've gone through that. That was there. Okay, first question that came in that he's been patiently waiting for. William says he's in a radioactive trade and the position analysis is telling me he can do a bear call spread. Is there a downside to doing that spread? With 500 shares and 5 puts, how many contracts should I do? Well, we always keep it the same, William. Okay, so if I'm doing an income method, selling a call, income method number 1, doing an income method number 6, I'm doing the same number of shares, same number of contracts. Let's take a look at what Foot Locker would look like, and I'll go back in a minute and show the other position. Let's just go to the profit and loss chart for our married put position. Okay, here we go. We've seen this a dozen times here. I got to do something else here, though. Let me go back. There we go. Let me reload this real quick. The skew kind of affected us a little bit, didn't give us the right chart because I increased the screen size. There we go, fantastic. All right. Now that the stock's at 59.36, similar to maybe your position, William, I might consider lowering this risk by doing income method number 6. So in this case, yeah, it's giving us good premiums because earnings are coming up. So in this case, I might look to sell the 60 call and buy the 62.5. And I have 100 shares and 1 put, so I'm going to do 1 call and sell one call and buy the other. If you had 500, you might do 5 and 5. All right, so income method number 6, the bear call spread. We're going to sell the first call. Let's call it 135 at midpoint, and we're going to buy the 62.5 call. Let's just put it at 55 cents. So what is this going to do for me? Well, I'm going to generate 80 cents of net credit to lower my risk down to 282. All right, and what are the pros and cons of this real quick as a review? Well, here's what happens. You get this little heartbeat with income method number 6. You leave the upside open. Infinite still upside profit potential. You do have this field here where you could necessarily not lose twice, but you're going to give up some money. What I mean by that is, as the stock moves above 60, you may be forced to deliver your shares of stock at 60. As the stock's moving up, your put's also declining. The reason why you have infinite upside is because you have this extra call that you received at a credit. Okay, so as the stock continues to move up after that, you still get the benefit. You might still get assigned on your stock, but you still have a 62.5 call that's gaining while the put is declining. Okay, so that's sort of the advantage of income method number 6. It's better than just selling the call in some cases, because if I just sold the call, we'd have a profit and loss chart that looked like our calendar put spread. All right, so in this scenario, you leave the upside open, but you have this range in here between the two strike prices where we might be giving up a little profit, and you'll be forced to manage the short call. Okay, but look what we did here. We did reduce the risk to only 4.5%. The position I'm in Foot Locker right now, I don't remember the exact price of the 60 put I'm holding, but I think because of income method since May, I've reduced the cost basis. Nope, that's not as high. Let's put this at 485. I think that's right. Oh, that's why. All right, I took two strikes apart, and I think I got 145 for this, and I bought this one for, I think it was 25. That's too much. No, that's almost exactly right. I apologize. This is what the Foot Locker position in the RadioActive Trading, the Fusion portfolio, looks like right now. So after doing about 5 or 6 adjustments, I opened the position with that income method number 12. The stock plummeted to 55. We adjusted 2 puts. We were able to bulletproof the position. I added the income method number 6, so I still have infinite upside on the position. I could liquidate right now for almost a 7% gain. If the stock collapses, I'm guaranteed to make 1.8% on the position. That's the current position on Foot Locker after applying some of the income methods. And if you have time today, you can go back to the RadioActive Trading site and check out the free webinar from Tuesday. We actually walk through what we did in these positions. Okay. Question came in a while ago from Michael. I'm sorry. Oh, did I have other questions before that? No. Michael says, if you think the stock is selected as going up, why not leg into the put after it rises and then put it a little cheaper? Because I'm not always right. In fact, usually on the first time, I'm usually right about 66% of the time. What does that mean? That means, let's go back to the original. If, this isn't the position, but we know that, of course, if I had bought stock Michael at 58.32 on Tuesday, and the stock moved up today to 59.41 or 59.60, and we saw that we probably could buy this put at about 4.45. That was the midpoint price, even though we paid 5.30 for it. I would only have a risk of 4.4%. Okay? What if I was wrong and the stock moved down $1.29 and was trading at $57 per share? Now this 60 put is going to cost me about $8.50 or $9.50. Okay, so if I was wrong and the stock moved down, let's say we paid $8.50, which is generous, now I'm at a risk of 10.2%, not where I want to be. And of course, if you tried the reverse, what if I got filled on the put first, thinking the stock was going to pull back and I wanted to get into it cheaper, instead of selling the calendar put spread to have 2 ways to lose, but the stock moved up? Now I've got that same problem. I got to buy the stock at a higher price, so my risk is higher. Michael, if you're better at timing than me, if you're better at picking stocks and timing a 2 to 3 day move, that's great. That would work out for you. This is something else that I've done before, but I found I did better in my portfolio over time when I found a stock that I liked and I found a risk that I liked as well. I'll enter the position right off the bat, knowing I'm guaranteed in. I'm comfortable with what I'd expect to see on the position if the stock moves up as well, okay? Paul says, what about the phase 2 trades before the initial put expires? Yeah, the Foot Locker position I've actually managed. I've got a November put, an August bear call spread on it. I've got earnings coming up at August expiration. So in general, I never hold the put all the way to expiration. I usually close it within 60 days to expiration. Why? Because I don't want to fall into that last part of the at-the-money bell curve. And that, of course, is described in the blueprint. Lewis says, of the 12 methods in the blueprint, are some better used when volatility is high and others when volatility is lower? Absolutely. Not absolutely, but yeah. Yeah, and those are discussed in the blueprint as well. If volatility is high, I'm looking at income method number 1, income method number 6 here for the boost in premium, possibly an income method number 5, maybe an 11. If it's lower, and I trade stocks with lower volatility, Johnson & Johnson, I had a favorable RPM in a couple years ago, Kraft, Avis, things of that nature. When the volatility is lower, I find myself sticking with income method number 3 and income method number 4 because the premium's not really there for an income method number 1 or an income method number 6. It works out really well. James says you could have bought a diagonal similar to a covered call. Yeah, instead of the calendar put spread, I could have done a calendar call, but that would have capped my gain. I would have been trading against myself because of my expectations for Foot Locker. I know what you're talking about with the leverage. I know what you're looking at. That's fine. What the argument there is that instead of this position here, we analyzed the calendar put spread to get in a cheaper cost, but I could have done a calendar call if I was neutral to bullish, and so I might have bought a 55 call, and the other day, let's call that at, I'm sorry, we'll call that on Tuesday, maybe about 570, 580. I'm going to go 580 with, yeah, I'm going to go 580 with that one. And I could have sold maybe the 60 call, nope, not that call. I'm sorry, I could have sold the August 60 call at that time for probably about 80 cents, 85 cents. I'll be nice, say 85 cents, all right? So this would have been a diagonal, probably showing a good profit right now. But remember, I was showing the comparison of what would happen with those 3 main questions that I get. And I'm not cherry picking, James. This is consistent that I see month after month, year after year from investors who see the new married put position. Why wouldn't I just do it as a calendar put spread? Why buy the stock? Why not buy an in-the-money call to simulate that? Or why not just buy the call outright? Okay. Here again, lie of leverage, risking 40.8%. I'm sorry, risking 495, higher than I would have with the married put. Potential for 40.8% return. Fantastic. But this is with earnings coming up on market open. If the stock gaps up, I'm going to have a small profit. If it gaps down, I'm going to have a large percentage loss. All right, that's what we're trying to fight against here. I don't want to take leverage positions. I don't want to take leverage loss. Is this more profitable now than it would have been? Oh, let's do it. Okay, so trade comparison Foot Locker. Let's insert this calendar put spread with 1 contract apiece. I don't know if these numbers are right, James. I'll verify them later what they would have been on Tuesday. Again, there we go. Where's my calendar call? Okay, calendar call gain of $35 or 7.1%. Okay, so that's better right now. But if the stock matches my gain expectations of 5 to 8%, maybe a little bit more, 4 to 6% even, then the married put's going to do better. Okay, and that's exactly what Lloyd just says. What happens when, oh, no, that's a different thing than Lloyd says. So that's what you're looking at there as well. Okay, so yeah, it's doing better right now. It's doing better than most of them. Again, I don't know if these are the exact prices. Okay, let's be nice here. I want to try to wrap up here because we're already at 1:15. Option chain. And let me go to August 9th. Let's take a look at midpoint at close. So selling the 60 call, I was close, would have been 95 cents. So on August 9th, the close for the August 19th 60 strike call is 85 to 95. And the January 55 call is what I used, 570 to 620. So we've been right about, 50 cents there, so 595. Okay, so I'm sorry, 595 and 95. Okay, it's pretty simple. It's not too far off of what I said there on the calendar call. In fact, the net debit would be exactly the same. It would have been $5, so I was really close. But let's edit the position. It's not going to change it too much. So had I opened the calendar call spread, we would have been at 595 for the long call on Tuesday and 95. All right. And the stock has moved up, so we're probably still going to have the exact monetary gain of about $30 or 6%. It's very similar if we liquidated right now. But again, we're not planning on liquidating. This goes to the next expiration. This goes to next week's expiration. And, you know, if I think the stock's going to be moving up, I'm going to do better on the married put. And then I've got this lie of leverage working very quickly against me to the downside. Is this following the 3 core principles? No. Would it be a better trade right now if we liquidated, if we opened those 5 trades and we liquidated all of them? Yeah, I understand what you're saying, James, but from the outlook, this isn't the position I want to be in. Okay, the trade has to match your expectations. You've got to practice proper position sizing, which you and I, James, have talked about before. Lloyd says, what happens when the stock trades sideways? Well, of the 12 different income methods that we do discuss in the blueprint, there are 3 income methods that you can use, of course, to apply in a neutral market. Income method number 8, income method number 7. I could try an income method number 6 if the profit and loss chart doesn't get too far out of whack. Those are all things that can be considered if it's neutral. I could also use income method number 3. For example, if I've opened Foot Locker, let's say 2 months ago, Lloyd, and the stock didn't move as I expected, and I'm coming up to earnings in the next couple of days, I could use a variation of income method number 3 to lower my risk on the position, but still have protection in place going into the earnings. All right. Now remember, folks, you know, throwing out these numbers, these different income methods of when you can use it, when you cannot use it, when you use one, when you use the other. But the only place to really know all 12 income methods and the initial radioactive setup is in the blueprint. It's 250 pages that goes step by step to the initial setup, when and how to use all 12 of the income methods, and some are used if the stock moves up, some are used if the stock stays the same, some are used if the stock moves down, or if you're anticipating the stock moving down. If you go to this special link, radioactivetrading.com/iridium, you'll see the 5 special bonus offers we're running right now. If you pick up the blueprint, we'll give you the quick action guide that Kurt put together. It's a $50 value. The Foundations of Radioactive Trading CD. It's one of the 6 Mastery Series CDs that Kurt put together. It's available in the Home Study Kit, the full program. But we'll give you the first of those 6 Mastery Series CDs for free if you purchase the blueprint. It's an $89 value. The Fusion subscription, where you can see the trades, the radioactive trades that Ernie posts, I post, Greg posts as well, and Kurt's track record, as well as all of our track records. If you pick up the blueprint, you can get your first month of Fusion for only $10. You also get a free month of Power Options for $60 value. You get a free month of Power Options, which we were showing today with the portfolio, the profit and loss chart. You'll also, of course, get a free Power Options coaching session, Power Options/radioactive trading coaching session with myself or with Ernie. The blueprint also comes with a money-back guarantee. If you purchase the blueprint, you receive it, you start going through it, and you feel that it's not going to match what you want to see for your portfolio or how you want to trade in your portfolio, just ship it back to us. We'll refund your purchase cost, no questions asked. All right. I did have another question that came in here, I believe, from Louis. Louis said, does a person who purchases the blueprint in the Iridium deal have enough time to study the blueprint before the free Power Options month begins? Absolutely. The free month of Power Options, you're given that right away, but it does not start until you first log on to the account. So you can take 1 month or 2 months to go through the blueprint, start getting familiar with it. You won't need that long probably, but you can start going through the blueprint. But if you don't feel comfortable with starting Power Options till 2 months after you have the blueprint, no problem. That 30 days does not start until you first log on to the account. You'll still have access for 30 days after your first login. The same is true with the Fusion. You don't have to start that first discounted month of Fusion at $10 right away. You can wait, and then when you feel you're ready, you can activate that electronic coupon and take your first month, whether it's 1 month down the road, 2 months down the road, or more. Okay? So that starts when you're ready. You're given it right away, but it starts when you're ready, Lewis, once you pick up the blueprint. All right, well, I don't see any other questions. I want to thank you all for staying with me. We're about 20 minutes after the hour. If you do have any other questions about the material presented or the radioactive trading techniques, remember, just send us an email at any time to support@radioactivetrading.com. Remember, you can also call us during market hours. If you live inside the U.S., you can reach us toll-free at 877-992-7971. Of course, you can also reach us outside. If you live outside the continental U.S., my apologies, you can reach us at 302-992-7971. Well, Louis, thank you. I'm glad you enjoyed the presentation. Thank you all for joining me today. I hope you got some useful information on the trade comparisons and why I don't open a radioactive trade using a calendar put to try to get into cheaper cost. We had the question come in from Michael. Now you know why I kind of don't try to time my trade and leg into it by getting the stock and then looking for the put at a cheaper price, because now I don't have the insurance in place. Or vice versa. Buy the put first, hoping the stock's going to drop and I can get a better price, and if it goes up, I'm scrambling to get in the stock before I'm losing too much positive delta on the position. The in the money long strangle, sure, you're using leverage, you have a lower cost, but you're delta opposed. You're going to need a much larger movement one direction or the other to start realizing a profit, and you can synthetically do that with actually a lower risk. We're using income method number 12 in the blueprint. And of course, the long call, we're not arguing that the profit and loss chart is not the same, but based on position sizing and proper discipline, I think we've showed how the just buying the out of the money long call is not a parity trade to the proper setup of the radioactive position. Well, ladies and gentlemen, thank you once again. We did record today's presentation. It will be posted in the archives around 5 p.m. Eastern Time. I hope you all have a fantastic trading day and a fantastic week. Hopefully we'll see you for one of our next webinars coming up. Take care, everyone. Good night.